current consumption, there must be commensurate inducement. This underlines the need for a positive rate of return on all potential investment, without which a person would prefer to consume all her or his income today rather than tomorrow. Such an investment consumption behavior is based on an important concept known as time value of money. This concept signifies a rupee today is worth more than tomorrow. The tomorrow must promise a larger wealth to give incentive to forego current consumption. The next natural question is how much larger return should she or he get to attract investment. You will readily notice that a nominal rate of return may well be fully swallowed away by the inflation. For example, if you earn an interest rate of 11% for 1 year on your investment and face the threat of 11% price rise, that is inflation, too during that year, where do you stand in terms of purchasing power of your money? What happens in a situation like this is that the 11% nominal return is neutralized by 11% inflation and you remain after 1 year where you were a year ago. It is therefore natural that an investor would be induced to postpone consumption today only if her or his command over goods and services does not get diluted over time. Thus, if she or he gets 11% nominal interest and 11% is the rate of inflation, her or his real rate of return would be zero. In the event of inflation, what induces investors to postpone current consumption are the real rate of return and not just the monetary rate of return. There is yet another dimension to that rate of return as an incentive to invest. For example, if a person buys, say, government securities, she or he is completely assured of all payments, namely interest and principal. In such cases, a relatively lower rate of return is adequate as an incentive. But if the avenue of investment is an organization's debenture, the probability of default does not exist, even if the rate of interest and the repayment schedules are known in advance. The investors here perceives some risk and would insist upon an additional compensation. In other words, the investor requires a risk premium over and above the risk-free rate. Speculation and gambling. Speculation and gambling are two distinct ways of increasing wealth in the face of risk or uncertainty. However, in the world of investing, these two terms are very different. Gambling is the act of putting money into an event with an uncertain outcome in the hope of winning more money, whereas speculation is the act of taking a calculated risk in an uncertain outcome. Speculation involves some sort of expected positive return on investment, even if the end result is a loss, while the expected return on gambling is negative for the player. Some people may be fortunate and win. Investment objectives. Assets manager use investment objectives to determine the best portfolio mix for a client. The investment objective guides the selection of investments. An investor questionnaire frequently defines financial goals and objectives and determines portfolio assets allocation based on an individual's time horizon. risk tolerance, and financial situation. Features of investment goals are as follows: a set of goals that determines an investor's financial portfolio is known as an investment objective. Using an investment objective, a financial advisor determines the best strategy for achieving the client's objectives. The risk tolerance and time horizon of an investor aid in determining an investment goal. Types of investment objectives. There are two types of investment objectives: primary and secondary investment objectives. These are discussed below. Primary investment objectives. First one, safety. Everyone wants that their money to be safe and secure. If you are a conservative investor who wants to receive their initial capital investment on time and without losses, then the safety objective is critical to you. However, you should be aware that no investment is completely risk free. However, if your primary goal is safety, you can make investments with low or reduced risk. Capital gain. When you want to grow your wealth, sorry, capital gain or capital appreciation is an important investment goal. While safety is critical, many people invest heavily in order for it to grow. Capital gains can be obtained through conservative growth, aggressive growth, or speculation. And the third objective, primary objective, is income. The income investment objective, as the name implies, means investing to generate a source of income for you. Dividends, interest, and yields are all forms of income. These investment goals have a high level of risk and low stability, but they also have higher returns. Income objectives are popular among conservative investors due to their attractive returns and ability to keep up with inflation. The stock market is an example of an income investment objective. It has high risks and high returns. Secondary investment objectives. The first one, liquidity. Another investment goal is the liquidity of the investment you make. The ability to instantly trade, sell, or convert assets into cash with ease in the market and with minimal risk of loss is referred to as liquidity. While some securities are easier to liquidate than others, this is not always the case. Most investors prefer to invest in securities that are easy to liquidate and use in an emergency. Next one, tax saving. Did you know that capital gains income is taxed differently than ordinary income? Yes, taxes on such income are lower than taxes on interest or salary based income. As a result, tax savings are a popular investment goal for many people. Tax free savings accounts and the National Pension Scheme are two examples of tax saving investments. Furthermore, life insurance policies and tax savings mutual funds are popular ways to save taxes while earning good returns. Actual returns on investments are after tax returns As a result, before making an investment decision, it is best to research and learn about all tax considerations and exemptions available to you in order to reduce your tax burden. Now, investment environment. The three elements of the investment environment are as follows: financial instruments. Financial assets or instruments can be classified in a variety of ways. We will classify them into creditorship and ownership securities on the basis of the nature of the buyer's commitment. The description will then be split into public and private issues, differentiating the two major forms of issuance. Now, first one, creditorship securities. Debt instruments furnish an evidence of indebtedness of the issuer to the buyer. Periodic payments on such instruments are generally mandatory, and all of them provide for the eventual repayment at maturity of the principal amount. Debt instruments can be issued by public bodies and governments, and also by private business organizations. Ownership securities. These instruments are called equities because investors who invest in them get a right to share residual profits. Equity investment may be acquired indirectly or directly, or even through a hybrid instrument known as preference shares. They are discussed in this order. First one, indirect equities. The investor acquires special instruments of institutions who take the buy-sell decision on behalf of investors. Such institutions are Unit Trust of India or mutual funds. Direct equities. The investor can subscribe directly to the equity issues placed on the market by the new organizations or by the existing organizations. If she or he is already a shareholder of an existing organization which enters the capital market for additional issue of equity shares, such an investor would get a pro rata right to subscribe on a preemptive basis to the new issue. Such offerings are known as rights shares. Established organizations reward their shareholder in the form of bonus shares also. They are given out of the accumulated reserves, and shareholders need not pay any cash consideration, as happens in the case of rights shares. A less popular instrument is called preference shares. It is neither full debt nor full equity and is therefore recognized as a hybrid security. Such a shareholder would have certain preference over equity shareholder. They may relate to dividends, redemption, participation, and conversion, etc. The most common is with regard to dividends, which, when not paid for any particular year, get accumulated, and no equity dividend would be payable in future until such accumulated areas of preference dividend are cleared. The dividend rate on these shares is normally less than the one on equity shares, but greater than the interest rate. Now, financial intermediaries. Financial intermediaries perform the intermediary function, that is, they bring the user of funds and the suppliers of funds together. Many of them issue financial claims against themselves and use cash proceeds to purchase the financial assets of others. The Unit Trust of India and other mutual funds belong to this category. The financial institutions engaged in intermediary activities include the Industrial Development Bank of India, Industrial Finance Corporation of India, Industrial Credit and Investment Corporation of India, Unit Trust of India, Life Insurance Corporation, and General Insurance Corporation. Two institutions which have broadened financial services activities in India deserve a special mention. They are the Credit Rating Information Services of India Limited, CRISIL, and other credit rating agencies, and the Stock Holding Corporation of India Limited. Financial market. Securities markets can be seen as primary and secondary. The primary market or the new issues market is an informal forum with national and even international boundaries. Anybody who has funds and the inclination to invest in securities would be considered a part of this market. Individuals, trusts, banks, mutual funds, financial institutions, pension funds, and for that matter, any entity can participate in such markets. Organizations enter this market with initial and subsequent issue of capital. They are required to follow the guidelines prescribed by the regulating agencies like SEBI from time to time unless they are expressly exempted from doing so. A prospectus or a statement in lieu of prospectus is a necessary requirement because this contains all material information on the basis of which the investor would for judgment to put or not to put his money. Concealment and misrepresentations in these documents have serious legal implications, including the annulment of the issue. Types of investment. Here are 6 types of investment to consider for long-term growth, along with information about each. We won't discuss cash equivalents such as money markets, certificates of deposits, or savings account, because those types of investment account are more concerned with keeping your money safe than with growing it. These types of investments are stocks, bonds, mutual funds, index funds, exchange traded funds, and options. Now we'll discuss them one by one. First of all, stocks. A stock is a financial investment in a particular organization. When you buy a stock, you are purchasing a share, a small portion of the organization's earnings and assets. Organizations sell shares of stock in their business to raise cash. Investors can then buy and sell those shares among themselves. Stock can produce high returns, but they also carry a higher level of risk than other investments. The second one, bonds. Bonds are loans made to organizations or governments. When you buy a bond, you are giving the bond issuer permission to borrow your money and pay you back with interest. Investors anticipate regular income payments. Investors typically receive interest in regular installments, typically once or twice a year, and the total principal is paid off when the bond matures. Next one, mutual funds. If picking and choosing individual bonds and stock doesn't appeal to you, you are not alone. In fact, there is an investment specifically designed for people like you, the mutual fund. Mutual funds enable investors to buy a diverse range of investments in a single transaction. These funds pool money from multiple investors and then hire a professional manager to invest it in stocks, bonds, or other assets. Next one, ETFs are short for exchange traded fund. ETFs are index fund that track a benchmark index and attempt to replicate its performance. They, like index funds, are less expensive than mutual funds because they are not actively managed. The major difference between index funds and ETFs is how ETFs are purchased. They trade on an exchange like stocks, so you can buy and sell ETFs at any time, and their prices fluctuate throughout the day. Sorry. Mutual funds and index funds, on the other hand, are priced once per trading day and remain the same regardless of when you buy or sell. Options. An option is a contract to buy or sell a stock at a predetermined price and by a predetermined date. Because the contract does not obligate you to buy or sell the stock, options provide flexibility. As the name suggests, this is an option. The majority of option contracts are for 100 shares of a stock. When you purchase an option, you are purchasing the contract rather than the stock. You can then buy or sell the stock at the agreed upon price and time. Sell the options contract to another investor or let the contract expire. Now, investment process. A typical investment decision undergoes a 5-step procedure, which in turn forms the basis of the investment process. These steps are: number one, determine the investment objectives and policy. Number two, undertake security analysis. Number three, construct a portfolio. Number four, review the portfolio. And last one, evaluate the performance of the portfolio. Now we are discussing them one by one. First, investment objectives and policy. The investor will have to work out her or his investment objectives first, then evolve a policy with the amount of investable wealth at her or his command. An investor might say that his objective is to have large money. You will agree that this would be a wrong way of stating the objective. You would recall that the pursuit of large money is not possible without the risk of large losses. The objective should be in clear and specific terms. It can be expressed in terms of expected return or expected risk. Suppose an investor can aim to earn 12% return against the risk-free rate of 9%. It means the investor is willing to assume some amount of risk while making investment. Alternatively, the investor can set her or his preference on risk by stating that the risk of investment should be below market risk. One example of investment objective may be that you require, say, 50 lakhs rupees for the marriage of your daughter, say after 10 years or after 20 years. Or you may require rupees 20 lakhs for the higher education of your child, say after 10 years. And for that purpose, what should be the rate of return you have to calculate, and this will be your investment objective. The next step in formulating the investment policy of an investor would be the identification of categories of financial assets he or she would be interested in. It is obvious that this in turn would depend on the objectives, amount of wealth, and the tax status of the investor. For example, a tax exempt investor with large investable wealth, like a pension or provident fund, would invest in anything but tax exempt securities unless compelled by law to do so. Some investors may entirely avoid derivatives because of high risk associated with such investments. Some investors may invest more in equities to earn higher rate but use derivatives to reduce additional risk. As in consumer products, financial products also come with different colors and flavors. And one has to be highly knowledgeable before selecting appropriate securities. Now, second one, security analysis. After defining the investment objective and broadly setting the proportion of wealth to be invested under different categories, the next step is selecting individual securities under each category. For instance, if an investor sets 50% of her or his wealth to be invested in government securities, the next question is which of the government securities that the investment should be made. It should be noted that not all government securities are one and the same. A long-term government bond is much riskier than short-term bonds. Similarly, investment in equities requires identification of organization stocks in which the investment can be made. Security analysis is often performed in 2 or 3 stages. The first stage, called economic analysis, would be useful to set broad investment objective. If the economy is expected to do well, investor can invest more in stocks. On the other hand, if the economic slowdown is expected to continue, investor can invest less in stocks and more in bonds. In stage 2, investors typically examine the industries and identify the industries. There are several classifications of industry. Investment need not be made in any one specific industry because many of the stocks may be overpriced in a growth industry. It is better to look for 3 to 5 industries and it depends on individual's choice. The issue is an analysis of broad trends of industry and future outlook is essential to proceed further on security analysis. As the last step, one has to look into the fundamentals of specific organizations and find whether the stock is desirable for investment. At this stage, investors need to match the risk return objective she or he has set in the previous stage. Organization specific analysis includes examination of historical financial information as well as future outlook. Using historical performance and future outlook, specifically the future cash flows, are projected and discounted to present value. Through such analysis, analysts quantify the intrinsic value of the stock and compare the same with current market price. If the intrinsic value is greater than the current market price, the stock qualifies for investment. Portfolio construction is the third step. In the previous stage, bonds and stocks which fulfill certain conditions are identified for investment. Under portfolio construction stage, the investor has to allocate the wealth to different stocks. A couple of principles guide such allocation of wealth. Investors need to appreciate that the risk of portfolio comes down if the portfolio is diversified. Diversification here does not mean more than one stock, but stocks whose future performance is not highly correlated. Further, too much diversification or too many stocks may also create problem in terms of monitoring. For example, if the investor decides to invest 10% of the wealth in software sector, it would be desirable to restrict the investment in 2 or 3 stocks based on the amount of investments. On the other hand, if she or he invests in 20 software stocks, the portfolio will become too large and create practical problem of monitoring. While including stocks in the portfolio, the investor has to watch its impact on the overall portfolio return and risk and also examine whether it is consistent with the initial investment objective. Fourth one is portfolio revision. Under portfolio construction, investor is matching the risk return characteristics of securities with the risk return of investment objective. In two conditions, the securities in which investment was made earlier required liquidation and investing the amount in a new security. The risk or expected return of security might have changed over a period of time when the business environment changes. The stock might also become less risky but offer lower return. That is when the risk return characteristics of security change. It will affect the desired risk return characteristics of portfolio and hence calls for a revision of portfolio of stocks. Another reason for selling some of the securities in the portfolio and buying a new one in its place is a change in investment objective. And last one, portfolio performance evaluation. The value of your investment changes over a period of time and it reflects the current market value of the securities in the portfolio. For instance, if you have made some investment in A some 10 years back when you first started investing, the value of A today is several times more than its value some 10 years back. Few stocks could have resulted in a loss, and it would be difficult to construct a portfolio of stocks only with winner stocks. Portfolio return reflects the net impact of positive and negative return of individual securities in the portfolio. At the end of each period, you may like to compute the portfolio return and risk and compare the same with your investment objective as well as certain benchmark risk return. The objective of this exercise is to evaluate the efficiency in construction and management of portfolio. Now, the second part of today's counseling, securities market. Primary market. When you intend to deal with the market on your own, you can deal with the market in two ways. The markets are accordingly classified into primary and secondary market. Primary market is the segment in which new issues are made, whereas secondary market is the segment in which outstanding issues are traded. It is for this reason that the primary market is also called new issues market and the secondary market is called stock market. In the primary market, new issues may be made in three ways, namely public issue, right issue, and private placement. Public issue involves sale of securities to members of public. Right issue involves sale of securities to the existing shareholder or debenture holder. Private placement involves selling securities privately to a selected group of investors. In the primary market, equity shares, fully convertible debentures (FCD), partially convertible debentures (PCD), and non-convertible debenture (NCD) are the securities commonly issued by non-government public limited companies. Initial public offerings (IPOs). IPO stands for Initial Public Offering. It is the process by which an organization offers shares of its stock to the public for the first time. The purpose of an IPO is to raise capital from public investors, allowing the organization to grow and expand its business operation. The process of going public through an IPO involves several steps, including selecting an investment bank to lead the offering, preparing a prospectus that outlines the organization business and financials, and setting an initial offering price for the shares. The organization also needs to meet various regulatory requirements before the IPO can take place. Once the IPO is complete, the organization's shares are listed on a stock exchange and they can be bought and sold by members of the public. The price of the shares is determined by supply and demand and can fluctuate based on various factors, including the organization's financial performance and market conditions. Eligibility for an IPO. In India, eligibility for an initial public offering is regulated by the Securities and Exchange Board of India, that is SEBI. To be eligible for an IPO, an organization must fulfill certain criteria set by SEBI. The eligibility is appended from time to time. As of now, The eligibility for an IPO in India is as follows. Minimum net tangible assets of at least rupees 3 crores for the preceding 3 full years. The organization must have a minimum operating profit of at least rupees 15 crore in each of the preceding 3 years. The organization must have a net worth of at least rupees 1 crore in each of the preceding 3 years. The organization must have a minimum of 1,000 shareholders and a minimum public float of 25% of the issued capital. The organization must have a track record of distributable profits for at least 3 out of the immediately preceding 5 years. IPO process. The IPO process has evolved significantly over time as markets, regulation, and technology have changed. Here are a few key ways in which the IPO process has evolved. Increased regulation. The IPO process has become more heavily regulated over time with requirements for financial reporting, disclosure, and transparency. The Sarbanes-Oxley Act of 2002, for example, increased the regulatory burden on public companies, making it more costly and time-consuming to go public. Then online investing. The rise of online brokerage and trading platforms has made it easier for individual investors to participate in IPOs. In the past, IPOs were typically only available to institutional investors and high net worth individuals. But now anyone with an online brokerage account can invest in IPO. Next, direct listings. In a direct listing, a company goes public by selling its existing shares directly to the public rather than issuing new shares through an investment bank. This approach has become more popular in recent years, with companies like Spotify and Slack opting for direct listing. Next is special purpose acquisition companies, SPACs. SPACs are companies that are created specifically to acquire other companies and take them public. They raise money through an IPO and then use the proceeds to identify and acquire a target company. SPACs have become increasingly popular in recent years as a way for companies to go public without going through the traditional IPO process. The IPO process has become more complex and more diverse over time, with organizations having a range of options for going public. SEBI guidelines for IPOs. SEBI issues guidelines for initial public offerings in India to ensure that the process of raising capital through the primary market is fair, transparent, and efficient. Some of the key SEBI guidelines for IPOs are eligibility criteria. The issuer organization must meet certain eligibility criteria to be able to issue shares through an IPO. The organization must have a minimum net worth, a track record of profitability for a certain period, and must not be undergoing any regulatory or legal action. These criteria we have just discussed. Disclosure requirements. The issuer organization is required to provide complete and accurate disclosures in the prospectus. The disclosures must include details about the organization's financial performance, risk factors, management structure, and other relevant information that can help investors make an informed decision. Next one, pricing guidelines. SEBI guidelines provide a framework for determining the price at which shares can be issued. The issuer organization is required to disclose the rationale behind the price and the factors that have been taken into consideration. Use of proceeds. The issuer organization must disclose how the proceeds from the IPO will be utilized. The disclosures must provide a clear understanding of how the organization plans to use the funds and the expected benefits to the organization and its stakeholders. Next one, book building process. SEBI guidelines provide a framework for the book building process, which is used to determine the demand for the shares being offered. The issuer organization can use either the fixed price method or the book building method to determine the price of the shares. Underwriting and merchant banking guidelines. SEBI guidelines also cover the role of merchant bankers and underwriters in the IPO process. The merchant bankers are responsible for preparing the prospectus and ensuring that the issuer organization complies with all the regulatory requirements. The underwriters are responsible for subscribing to the shares that are not taken up by the public. These guidelines are regularly updated by SEBI to ensure that the process of raising capital through IPOs remains fair and transparent for all the stakeholders involved. Now, secondary market. The secondary market is the segment in which outstanding issues are traded and thus provide liquidity. Investors who seek both profitability and liquidity need both primary and secondary markets. There is thus a direct and complementary interface between the primary and secondary markets. Secondary markets exist both for short-term, that is money market, securities, and long-term securities, that are the stocks. It exists for debt, equity, and a variety of hybrid securities. That means debenture, etc., equity, stock shares, and hybrid securities like preference shares. While the secondary market activities in money market securities are conducted over phone or through market makers, the trading is more organized for long-term securities and conducted through stock exchanges. Buying and selling securities in secondary market is fairly simple. Investors have to open an account with a member of a stock exchange and then place orders through the member. Indian stock market. The Indian stock market has evolved significantly over the years with the introduction of new technologies and regulatory measures to ensure transparency and efficiency in the market. The stock market has become an important avenue for investment and wealth creation for millions of investors in India. There are several stock exchanges in India, but the major ones are: number one, NSE, National Stock Exchange of India. It is the largest stock exchange in India in terms of market capitalization and trading volumes. It is located in Mumbai and offers trading in equities, derivatives, mutual funds, and currency futures. Then, the oldest stock exchange market of the India, Bombay Stock Exchange, BSE. It is the oldest stock exchange in Asia and the first in India, established in 1875. It is also located in Mumbai and offers same trading in equities, derivatives, mutual fund and currency futures. Next one, Metropolitan Stock Exchange of India, MSEI. It is the third largest stock exchange in India and is located in Mumbai. All these stock exchanges, they are mainly located in Mumbai, and it offers again trading in equities, currency derivatives and debt instruments. Indian Commodity Exchange, ICAX. It is a commodity future exchange and is located in Mumbai. It offers trading in commodity futures such as gold, silver, and crude oil. Then Multi Commodity Exchange, MCX. It is another commodity futures exchange located in Mumbai. It offers trading in commodity futures such as gold, silver, and crude oil. National Commodity and Derivatives Exchange, NCDEX. It is a commodity future exchange located in Mumbai. It offers trading in commodity futures such as agricultural products, metals, and energy. Role and functions. Stock exchanges play a crucial role in modern economies by providing a platform for buying and selling securities, such as stocks, bonds, and derivatives. Some of the key roles of stock exchanges include facilitating trading. Stock exchange provides a centralized marketplace where buyers and sellers can come together to trade securities in a transparent and regulated manner. Number two, price discovery. The stock market helps to determine the price of securities through the forces of supply and demand. The prices of securities on the exchange reflect the collective judgment of all the buyers and sellers participating in the market. Next, liquidity. By providing a platform for trading, stock exchanges enhance the liquidity of securities. This means that investors can easily buy and sell securities at any time, making it easier for them to manage their portfolios and adjust their positions as needed. Next one, transparency. Stock exchanges provide transparent pricing and reporting of trades, which helps to promote market efficiency and fairness. Next one, capital formation. Stock exchanges play a critical role in raising capital for companies by facilitating the initial public offerings of new companies and providing a platform for companies to issue additional shares or bonds to raise more capital. NEAT system. NEAT stands for National Exchange for Automatic Trading, which is a fully automated screen-based trading system that was introduced by the National Stock Exchange of India in 1994. The NEAT system has several different market types that are used for trading different types of securities. These market types include normal market, means normal where the securities are traded, odd lot market, only for the securities which are in less than the standard trading lot, and retail debt market. This market type is used for trading debt securities such as bond, debentures, and government securities. Wholesale debt market. This market type is used for trading debt securities in large quantities. It is primarily used by institutional investment such as banks, mutual funds, insurance companies. Then call option market and block deal market. Overall, the need system of market provides a range of options for investors to trade securities in a manner that suits their specific needs and preferences. That's all. Namaskar.